Good evening from Beijing. I'm Kate Quay. Last week, in our 2022 Economic Prospects series, we interviewed three guests, Fan Gang, Gao Bing, and Charles Li. They gave us their respective views on outlook for the global economy in 2022 and dynamics between China and the United States. Markets have also given their reaction and response to the year ahead. Since January, U.S. equities dropped about 10% already, and VIX index also increased to a recent high. To further explore what to expect in 2022, today we continue our discussion with Professor Zhu Ning from Shanghai Jiao Tong University. Professor Zhu is a renowned economist, and his famous China's Guaranteed Bubble is a very enlightening and popular read among global audiences. So, Professor Zhu, very good to have you this evening with us.
Nice to be here.
Great. While we are talking, we are all probably waiting eagerly for the Fed meeting minutes today. In general, what kind of 2022 shall we expect in your view?
Well, I think it's going to be a turbulent year. For both China and the U.S., for both the fundamental economy and also for the international capital markets. And we have to keep in mind that we're just coming out of the recession resulting from the COVID. So as a result, I think we're still seeing quite a bit of unusual monetary and fiscal policy gradually tapering off. And in light of this, I think we're also seeing the global supply chain and the global financial and trade order are still adjusting as a result of the COVID. So I think we're going to see a lot of changes this year. And for China, I think it's probably more important that we keep in mind this is a very significant year. We're going to hold the 20th plenary in the later part of this year. So I think we're going to have probably a better management of the market expectation of, well, this is going to be a largely positive, growing, and a supportive year. And for the U.S., I think with the midterm election in the backdrop, I think it's going to be a lot of adjustment in the both economic and the social policy. So I think we're bound for a lot of changes and maybe surprises this year.
So basically you're saying that we have more reasons to be cautiously optimistic or even alarmed than being hopeful.
Yes, I think cautiously optimistic is what I would lean towards. I think there is a lot of optimism because, well, the economy has been rebounding still healthily and strongly from the recession caused by the COVID. And on the other hand, I think we are seeing a lot of countries are gradually grappling their battle with
Professor Zhu Ning, yeah, I think Professor Zhu Ning encountered some web jam, so we are waiting for him to get online again. What you're watching is live from CGTN online platform from Beijing, and we are continuing our discussion of 2022 economic prospects. And today our guest is Zhu Ning from Shanghai Jiao Tong University, who is a renowned economist. And by the way, he is also Robert Shiller's student, and he has his famous publication called China's Guaranteed Bubble, which is a very enlightening reading and was so popular among Chinese audiences. I have my questions laid down today, mostly on the monetary policy side and also asset price side in both China and the United States to him. And also I think tonight we're going to touch upon the exchange rate of RMB against US dollar this evening. We are also going to touch something on the green energy transformation front because that is certainly very important in the economic dynamics globally. And as two biggest carbon emitter, China and the United States, how they position themselves on the green transformation is probably critical to the global economic growth. Also, we are going to talk a little bit about China and US relationships in the year ahead. Interestingly, between 2014 to 2018, we have seen a similar circle when US government is tapering off, and then also they are basically trying to lessen the liquidities on the market. How a global currency and capital markets respond to such tapering? Can we compare this round of tapering of Circle to what we've experienced between 2014 to 2018 is something that we will also explore with Professor Zhu Ning. Professor Zhu, are you back online now? Okay, let's wait for him for a bit longer. Last week, we actually had three very enlightening dialogue with three renowned economists in China. They are Professor Fan Gang, Professor Gao Bing, and also Charles Li, who is the former chief executive of Hong Kong Stock Exchange. They gave us their respective views on the capital markets, monetary policy globally. Professor Fan Gang mentioned two things very interesting. First of all, he actually foresees a continuous easing monetary policy in China, and also, in his view, fiscal debt is probably one of the mitigants, one of the solutions to help Chinese economy getting back on track, and also will potentially boost the global economy as well. Charles Li gave us his insights on the global capital markets, Hong Kong and also United States. Well, Gao Bing's comment on global markets is basically he thinks that Hong Kong market this year we're going to be a bull market for sure because asset price is relatively undervalued, while U.S. market is overvalued in his way, in his mind. So actually, I see Professor Zhu Ning getting back online. Right. Okay. He's adjusting his camera right now. In Professor Gao Bing's view, that he mentioned he thinks that U.S. market is relatively overvalued. So it's not a surprise for us to see the U.S. Equity markets actually drop in January. Actually, right after we finished dialogue with him, U.S. market continuously dropped for 2-3 consecutive trading days, and S&P lost about 10%. So to a certain extent, which fits what Professor Gao Bing told us during dialogue. So, okay, Professor Zhu Ning, now you're back with us. Can you hear me now?
I hear you, Kate. Sorry about that.
Great. It's okay. Let's continue our discussion. You will just give us your insights on what kind of 2022 we should expect in general. And then I think we ended at you were saying that optimistically cautious is probably something that you will lean to. Yeah, so please go ahead.
Okay, right. I will just pick up where I dropped on. I think it's quite interesting that the global economy is on the path for a healthy recovery. And what's the cautious part is, well, because the U.S. is going to gradually taper off the monetary and the fiscal stimulus that it has unleashed over the past couple of years. So that is something where the market has been counting on the U.S. will be more accommodative with its monetary policy for a longer period of time. And in light of the inflation, I think this is probably going to change quite drastically. And I think that is the cautious part. But overall, I think the global economy is rebounding and coming out of the bushes from the COVID, which is, I think, quite encouraging to both China and the US.
Right. One of the critical question or one of the critical thing among all these dynamics is actually the asset price. We've seen the asset price drop in China, and we have seen certain real estate companies facing difficulties in terms of financing. So how would you project the asset price trend in 2022, both China and the US side?
Well, I think people joke that the only thing certain about asset prices is that they will fluctuate.
Right.
So I think we'll see a lot of fluctuation in 2022 as well. But if we zoom in on, I think both the housing market, the property market, and the equity market, I think in China, people's opinion is, well, the housing market is probably the more concerning part because it's the largest asset allocation class for Chinese households, and also because by traditional or conventional standard, China's housing prices are quite high relative to both the housing, both to population income and also to the rental yield. So I think there is probably where people are paying more attention to. And of course, the Chinese stock market has also experienced some fluctuation over the past couple of weeks. And I think it's largely a reaction to what has been happening in the U.S. And also we're seeing that China's capital market is gradually gravitating towards a more growth, more high technology, more self-reliance technology. So I think that's a transition, a structural change. And I think I think the situation is a little bit tricky for the US. The stock market has been going in a bullish run for almost a decade by now.
Right.
And by conventional method, according to Professor Robert Schiller, I think the valuation for the stock market is the second highest, only lower to what the market experienced around the internet bubble. So I
Yes.
think in terms of the valuation, the market is quite rich or a little bit precarious. And another thing which I think mentioned earlier is because the market has been betting very heavily on the heavy stimulus coming from the Fed, the accelerated uh, tapering off of the stimulus and also the potential or maybe the more drastic interest rate increase in the coming several months, I think that is going to cast a lot of dark clouds over the market. So I think for the U.S. market, I tend to agree with. I just heard you some of the previous guests. I think the U.S. market is probably poised for some big correction in 2022.
Right. You were actually one of the early critics of the asset bubble in China, the potential asset bubble in China. I think as early as 2016, and it took about 5 years' time, until probably last year that we see the asset bubble in China started to burst, or they're still in the process of getting burst. So, what could we have done earlier to make the situation better? Because Evergrande, for instance, and other real estate companies are actually causing very negative impact to the global equity markets and also to the credit of Chinese companies.
Right. I think the most important thing in housing market or maybe in all asset class when we are talking about the bubble, I think we're actually talking about or focusing on the expectations of the investors. So I think it's the expectation management, I think that has been a little bit lacking or not very well managed over the past 5 years. I mean, specifically, I will bring up two things. One is the property tax.
Right.
I think China is one of the few countries in the world which does not have a property tax which is levied on a sustainable basis. And this is, of course, sort of pouring fuel to the fire to stimulate the speculation intent of the market. The second thing is what has been going on quite aggressively from 2016 through 2018, the so-called shantytown reform. This is a very aggressive efforts from the government trying to upgrade or improve the living quality of the residents in especially third and fourth tier cities. And those are very good intentions, but then we have to keep in mind that it's actually a man-made sort of bullish market or man-made positive expectation which were imposed on investors. So for the past 5 years, I think until through the COVID period, I think almost every single household in China believes housing is the best investment.
Right.
And that's a very scary expectation to have because people would borrow as much as they can, try to speculate in the housing market. So I think those are the things. I mean, in one word, it's expectation. And then I think we probably have already sensed from the Central Economic Working Group meeting last December in a way that I think the policymakers are also paying attention to how do we better manage expectation in both the housing market and in the overall economy.
Right, but if you look at the saving rates of Chinese residents, the saving rates is still relatively high. I think the saving rates is probably the highest globally. So even though, as you just mentioned, Chinese residents, they borrow very aggressively and trying to fund their housing mortgage. But from that part, I don't think that is yet a problem. I think the loan side, the housing loan side, is still relatively healthy.
I beg to differ. I think the same argument can be made 5 years ago.
Right.
But I think over the past 5 years, if there's one major change, that is the leverage or the level of indebtedness for Chinese households. So if you look at China's overall debt problem, it has actually been moderating over the past 5 years. It is exactly the housing sector or the household borrowing sector that has increased quite drastically over the past 5 years. And the main purpose for the households borrowing is to invest or speculate in the housing market. So in that regard, I think we still have to be very watchful with Chinese households' level of indebtedness, which is among the highest among all emerging markets, and it's like shoulder by shoulder to some of the level of indebtedness for developed economies. And that being said, I do agree with you. I think the overall level of saving is still fairly high for Chinese households, and there are probably a couple of reasons which are responsible for that. One is probably the cultural or the life habits, but that's not to forget about one other aspect, which is precautionary saving. This
Right.
means that if people are concerned with my retirement, my health care, and with my future job security, then they have the tendency to save up and preparing for something that's not so positive. So I think this is also something reflective of what China has to work harder on the social welfare programs to provide or improve the confidence with the economy, and so that people can have more disposable income. They can actually withdraw their money, spend, and stimulate the economy to keep growing.
Right. Okay. Previously, housing market or the housing market, real estate market contribution to GDP is probably one of the most important factors to Chinese GDP in terms of contribution. But now, if we want to clamp down the real estate market, how can we make up the short of the GDP growth?
Right. I think that's a trillion-dollar question, and that is one question I think China is thinking very carefully about. I think before the correction, the real estate sector make up about 18% of China's GDP growth,
Right.
and real estate and related industries make up almost 30% of the total GDP growth. So this is very significant. And we have to keep in mind, I think, first of all, this is not sustainable. I mean, both the housing prices and the speed by which the housing price has appreciated is really unsustainable, no matter whether you're looking at China as a country historically or you're looking across the world. So in that regard, I think this is bound to happen. But your question is right on the money in the way of what are the potential growth spouts
Right.
which can make up for the potential loss that we are giving up or giving away from the crackdown on the housing bubble. So I think there are two major areas. One is, I think, consumption. Chinese
Right.
households or China's household income has been increasing quite a lot. I think this past year, China's GDP per capita is cracking the threshold of 12,000 US dollars, which is already stepping into the lower bound of the high income countries. So Chinese households have much more diverse and stronger demand for a better lifestyle. So I think this is creating a huge demand for both services and better products. The second is technology. I
Right.
think China has gradually transitioned away from made in China to design in China to mindset in China. So in that regard, I think China has generated a lot of unicorns or already giant companies in technology, in electronics, in automobiles. So in those regards, I think those new sectors which are driven by technological advancement, I think they are going to gradually make up for the losses that we are giving away from real estate. Of course, this is going to be a gradual and somewhat challenging transition. I mean, it's always easier that you are growing at a faster speed than trying to moderate a little bit. But I think in terms of how big China's economy has grown, and also in terms of how unsustainable the model that's driven by a housing market, I think this is a necessary and the reasonable transition that we're going through in the next few years.
Right. But are we really seeing consumer spending picking up right now, as far as figures stands for?
Right. This is actually one area that I am more concerned with China's economy. I think the China's trade number was really strong last year.
Right.
And I think in this year, especially in light of the 20th plenary, I think we are going to see a lot of investment of projects initiated by the government. It is the consumption which is somewhat disappointing. And it is also the consumption which I think shoulders the most of the heavy lifting to sustain China's economy going forward in the next decade or so. So I think there are two major reasons. The first is the COVID. And let's not forget how much the pandemics has changed different people's lifestyles in terms of traveling, in terms of entertainment, in terms of eating out. There are so many areas where the scenarios are just not there. And especially given the recent coming back of some COVID cases in China, we're already experiencing the changes in sort of what are allowed, what are encouraged, what are prohibited. So I think that is a big reason why the consumption is not showing as much vitality as it should be. But the second matter, which I have been advising the policymakers over the past 2 years, over the course of COVID, is still a better infrastructure, a better safety net, and a better social welfare program.
Right.
I think people are, it's not because people don't have the money. People have the money. They probably don't have the confidence to spend the money. So how can we improve and manage their expectation? Coming back to your earlier question about expectation, I think that is really important. And I think that is something where I think the fiscal stimulus should be focusing on. I don't think we need, I mean, we still need more roads, more highways, and more airports. But given what we have been building over the past decade, I don't think we need those as urgently as we need for a better healthcare program, for a better retirement program, for a better retraining program for those people who lose their jobs in the wake of COVID.
So basically, you were saying that government needs to take more initiative, a better initiative, to help consumers get back their trend and get back their eagerness to spend. To a certain extent, is their trust to the society, trust to the government, and trust to the good economic trend. So they are able to spend. They're willing to spend money. You also mentioned very interesting earlier, which is the investment, by the government. That made me thought about investment return. If government is spending a lot and then government's role is becoming more pronounced, does that mean actually small to medium-sized enterprises are losing their initiative or their incentive to perform under the economic growth saturation? How should we better incentivize them? Because by and large they contribute about 70% of the innovation, and they contribute a huge share of the national economy and also employment as well. If they don't see those investment return, they won't be willing to invest. And then if they're not willing to invest, consumer spending will also become a problem. Then we're going to fall into a trap. So how should we avoid this kind of problem?
A very good question. I think a question that economists have been thinking a lot, very hard. And I think that the short answer is, well, we have to strike a balance. And I think according to the mainstream of economics, I think we do believe government is very important. It is extremely important, especially in a situation where like a pandemics or when there is not enough aggregate demand. But once we're coming out of the aftermath of the pandemics, I think we should gradually phase off some of the government interference and let the market play a more deterministic role in allocating resources. So I think that's a general opinion, because we do have this term called crowding out. If the government is doing a lot, then that's crowding out what can be done by the private enterprises. So I think that is a balance we have to strike. And I think in the context of China's particular scenario, I think there are two things which are very important. I totally agree with you on the importance of the private enterprises and on the small and medium enterprises. So for them, I think there are two challenges. One is, I think, financing. I mean, I think it has been a long-term struggle for China and China's financial sectors how to better help small and medium enterprises to get finance to support their growth, to make their ends meet. So I think that's still one area we have to keep working on. The second is, I think, the leveling the playing field. I think even when we're coming down here, I mean, it could be coming from the financing, from the availability of bank loan. It could be because, the nature of the firm would determine whether a company can successfully bid a project or not. I think we're still seeing sort of, I wouldn't use the word discrimination, but sort of differential treatment for a large company versus small one, for state-owned enterprises versus private enterprises. I think that is something which is hurting the confidence or the initiative of entrepreneurs. So I think that is something, especially now that we are managing the COVID very well, I think we should gradually restore back to the more market-driven stimulus approach. And also we would want to have those private enterprises and those entrepreneurs try as much as they can as before. One is before the COVID. The second is as if they're playing in the same leveling field with the SOEs.
Right. So basically to protect the entrepreneurship, to make innovation possible. I witnessed one interesting phenomena is that even though US and China are probably undergoing a different monetary policy in 2022, where China is probably continuing to ease, where US is tapering off, but both countries are experiencing to a certain extent economic structural change. What's your take on that?
Well, I think probably I have a couple of responses. One is I think decoupling is a notion which I think emerging market economists have been talking a lot over the past decade or so. But I think it will be quite difficult for China to decouple from the monetary cycle from the US. So I think that is an assumption, but that assumption has been proven wrong and wrong again over the past decade. So I'm not too sure that we will be able to distance China's monetary policy completely from that of the US. So in certain senses, I think the recent interest rate cut that we have witnessed in China might be actually a preparation for the potential interest rate hike as a result of the potential hike from the Federal Reserve. So in that regard, I think there are some discontinuity or a lack of synchronous coordination between China and the US, but I don't think those two countries are going into opposite directions in terms of monetary policy for the rest of 2022. I think that's the first thing. The second thing is, regardless where the monetary policy is headed, I think structural change or structural reform is very essential to every country. I think different countries have their own structural challenges and have their own difficulties with economic, social, and political situations. That being said, I think each country would have to dive down and look closely at their respective challenges and really willing to take some of the short-term pain in order to achieve the longer-term goal of having a more sound structural change. So I think for the US, it's probably the wealth distribution. I think that is one very diverging force, which is now having I think, unnecessarily large influence over presidential election, midterm election, and also some of the social policies. And for China, I think it's still about how to better coordinate the relationship between the state and the market, as we discussed earlier. I think both have its power, but then how do we better motivate the entrepreneurs to unleash their entrepreneurship at the same time, trying to propel common prosperity, trying to make China's growth more inclusive. I think those are all very important structural reforms which are lying ahead of respective countries.
Right, you actually mentioned a very interesting point. You're basically saying that China will probably not continue to ease its monetary policy. Well, on the contrary, you will probably tighten its monetary policy by increasing its interest rate. But wouldn't that make the situation even worse while we're actually facing supply shock, weakening expectations, and demand shrink?
Right. I don't think China is going to tighten as long as the US tightening process is not too drastic.
Right.
But I think China's monetary policy is not as accommodative as the market has been expecting since the end of last year. And I think people are probably a little bit ahead of self of expecting something as aggressive as what we have witnessed back in 2016 or back in 2009, the so-called flooding of monetary stimulus. I don't think that is going to happen for two reasons. One is China's housing prices are already standing at a very precarious level. So in order to contain the asset bubble and in order to prevent the potential systematic financial risks, I don't think the PBOC will go as aggressive as many have been hoping for. The second is we use the history as a benchmark. The PBOC has rarely reduced the interest rate in light of a US Federal Reserve interest rate hike cycle. So in terms of that, I think it's very difficult for China to go against the Fed in that regard. I don't think China is going to tighten, but I think the loosening or the accommodation in the monetary policy will not be as aggressive or as supportive as people have been hoping for. So you're quite right. I think we do need a more accommodative and a more active fiscal policy to support China's economy. And also, I think at the same time, we also have to rely more on the better management of those policies. So we have to be very careful about the debt problem, the asset bubble problem, which are all coming as a result of the big flooding stimulus that we have rolled out back in 2009. So I think for that, we do want to achieve the goal of stability. And also to make sure, based on the stability, we want to move forward. But then we'll also have to keep in mind that moving too fast could have very serious unintended consequences, which we might have to live with for the next few years.
I think that's very, very clear. Thank you. But under this context, how would you foresee RMB exchange rate against the US dollar in 2022?
Well, I think in the short term, the RMB exchange rate will remain quite strong for two reasons. One is I think China's trade numbers are still very strong. And I think trade numbers are always a very good indication of where the exchange rate is headed. For the second is, given a few changes in the past year, I think we're already seeing, well, there's still a very strong demand for China's capital market and China's bond market from overseas investors. So I think both the trade numbers and the capital flow numbers will bode very well for China's exchange rate in the short term. But I think in the medium to longer term, we are going to see a wider range of fluctuation, which I think is both what the PBOC has intended for and also what the China's economy is needed. Because we have to keep in mind the strong export in the past couple of years will probably not sustain because the rest of the world is catching up with their own share of the production. And with that, we have to keep in mind a very strong RMB is not very helpful to China's export. So I think the PBOC would have to keep a balance between, well, the short-term gain in the strength of the currency and also the potential side effect as a result of the potential loss in the export.
Right. You just mentioned automobile in the new energy sector. So the green energy transformation is probably one of the biggest things in our era. Everyone is trying to replace fossil fuels with clean energy. What's your take on this green energy transformation, and what is the implication to the potential geopolitical dynamics in the next, say, 5 to years' time, especially between China and the US?
Well, I don't think it is confined to the dynamic relationship between China and the US. I think carbon neutrality is a very significant matter for both China, and the US, and also for the entire world's environment and Earth's sustainability for the entire human race. So I think it's really the big deal that the entire human race, the entire world would have to think carefully about for the next century. That being said, I think there are still a few very key areas we would have to explore. One is the public awareness of carbon neutrality or sustainable growth or green technology. So, I think some people simply equate new energy vehicles with carbon neutrality, which has very little to do with each other. So in that regard, it's just not a way of how to use your energy, but also the source of the energy or right. on the protection of the environment. So I think there are two things which are very important that China brought up the topic of carbon neutrality in the earlier part of 2021. I think on one hand, it is really a very responsible gesture that China was making to the world, because China used to be, or it still is, the largest emitter in the world, given China's size and also given China's dependence on coal burning and energy source. But I think China's gesture is very well received by the rest of the world and also reflects China's ascent to a large international power. So I think that's very encouraging and also very laudable. The second thing is, I think for China, it's not a trivial task. And in terms of reaching the carbon emission peaking of 2030 and the neutrality by 2060, it will be one of the fastest, if not the fastest, pace for a major economy to achieve those goals. So it's not an easy task. I hope the rest of the world would both admire China's ambition and also understand the difficulty and the challenge that China would have to go through. And in terms of its implication to the China and the US relationship, I think it's a very encouraging and a constructive area where these two countries can work very closely on. I think in an era where the trust and the respect were gradually going away between China and the US, and in a period where I think the area of collaboration is not expanding, I think carbon neutrality and the sustainable energy is really one key area which is not only beneficial to both countries, but also beneficial to the world as a whole.
Right, great. I think that's very clear. My last but most important question to you probably is, what is your take on the global equity markets, respectively the Asian markets, Hong Kong markets, and US markets in 2022?
Well, I think there are two things to bear in mind. One is this is a tapering year. This is an interest rate hike year. So in that backdrop, I think the market will definitely not do as well as in the past couple of years. And given how high or how rich the valuation has been for the US market, I think we'll probably see a bigger correction in the US market compared to the rest of the world, especially the Asian markets. And among the Asia, the Hong Kong and the US market, I think one thing is clear, that is those companies which have exclusive technology, which have very large consumer or user base, those which have a very unique business model, they would still probably be very highly favored by the market and enjoying their already very lofty valuations.
Right, great. I think that's very encouraging recommendations and very thoughtful insights. Thank you very much, Professor Zhu Ning. That brings to the end of our today's live discussion with Professor Zhu Ning from Shanghai Jiao Tong University. Well, apparently there are a lot to expect in the year ahead in 2022. We do have a lot of problems globally, but also we have a lot of hope. So let's all wish for a better 2022. Stay tuned for the next time. Thank you very much. This is Kate Kuei from Beijing.